A large part of the fall in the rupee is because of the current account deficit, which means that we are buying more foreign goods rather than what we are selling in terms of foreign exchange. A large part of the deficit, current account deficit of 4.5% right now is because of imports of oil and imports of gold, and the prices of both these commodities have increased a lot over the past 4-5 years, which has further accentuated our problems in terms of current account deficit. If one excludes oil and gold, instead of a current account deficit, we have a current account surplus for some time in the range of about 2.5% of GDP. Some of the recent volatility in the rupee was also because of the actions which were taken by the government and the RBI. The RBI did put some of the controls in terms of the amount of capital which can be invested by individuals as well as companies abroad, and this restriction sent a fear among many investors, including the foreign institutional investors, that can there be harder controls, and this led to a flight of capital and further fall in the rupee. While we see that the markets in the short run they tend to overshoot themselves, and we can be very, very different from what the fundamental value can be, and this is probably true of the Indian rupee also. So while the short term it will be very, very difficult to predict, based on the fundamental value, which is the real effective exchange rate or REER, the rupee could probably find its value at somewhere around 52 to 55 rupees. The REER is based on the purchasing basket of between two different kind of currencies. So while the short term is difficult to predict, we certainly see that probably rupee is oversold at this point of time.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.